Good morning. Welcome to the year-end financial planning and tax consideration webinar. I'm Melissa Joy and thrilled to be joined by my colleague Alexa Kane. And without further ado, we're going to kick this off. If you're just logging in or if you know somebody that only caught the tail end, everything's recorded. It'll be on our YouTube channel and in our newsletter. So let's get started. We have a lot of great information today, and I'm excited to talk about it. Okay, we do this webinar every year because there's just so many opportunities, especially as you think of the calendar year, to wrap things up and get things started. And some of those are really critical in time. That there's a time limitation, and for other things it's just a good time of year to refresh and renew. So we've got a jam-packed agenda. We're going to try to go broad, but I hope you have a sheet of paper where you can jot down some notes. Even if there's a few things that apply to you, that's a win as far as we're concerned, especially if you get them done. So we're going to talk about what you should review. We're going to talk about retirement contributions for now and later, open enrollment, Roth conversations. And then it's really important when you think about financial planning, it's not just about your investments and retirement. There's other elements as well. So we're going to try to cover some of those elements, including estate planning, charitable giving. And then we're just going to do a mindset reframe when it comes to both what you could be thinking about having accomplished this year, as well as setting the table for 2024, which is sure to be an eventful year as well, hopefully in your personal life in a positive way, as well as with, the world and elections and all of those things. So without further ado, I just want to remind you, like I said, have that blank sheet of paper where you can make a list of action items. But please, if you're able to just do one thing, we really love to embrace incrementalism. It helps to combat overwhelm, fatigue, and anxiety when it comes to finances and everything else. So if you're able to just make a list of a few things that you want to accomplish, whether it's yourself or your family, that's a win. And for those things that you need to do, but you don't have time to do them right now, add them to your list, put them under a soon label instead of a now label or even a later label. And then mark some time in your calendar for January, February, or sometime in the future where you can tackle those things if they're important to you. Okay, Alexa, I'm teeing things up and handing off to you. Let's get it started with diving right in.
Perfect. Yeah, one of my favorite things to talk about is goals. And a lot of the work we do is, what are your retirement goals? What do you want to achieve and what do you want the future to look like? And while we talk about the future goals, it's also really important to take a step back and look at what you have already achieved. So what have you accomplished this year? What have you crossed off the list? Because there's always going to be things that need attention, but it is just taking a minute and telling yourself, I I got some stuff done and I was making moves. I know a lot of times when we do the net worth reviews with clients, especially if it's been a tough time in the markets, people are like, I haven't made any progress. And we're able to say, no, but look what what you've done, and you've paid down the house and you've achieved all these things. And so it's nice to take a step back from every day, things seem to not be moving, but when you look from further away, you've made a lot of progress. And I think it's a good time to see where you've come and also to identify the future goals and what you want to accomplish in the near term, so 2024, and also for the long term. And I know Melissa talked about being incremental and also making things easier. And to me, one of the easiest or simplest goals to achieve is making small increases to your retirement savings plan. So bumping up by 1 or 2% at the end of the year and just slowly setting yourself up for success for the future. So lots of goals that we can achieve and help people work towards. And then the investment review, kind of in line with your goals. What has changed? Are there big purchases coming up? Are there things that we need to plan for Do we need to get some cash or more liquid investments available for upcoming purchases? Or if you are entering the next phase of life, which is retirement, how are we going to set up the income stream? And are you still comfortable with the investment allocation that you have been on? Have you rebalanced your accounts this year? It's oftentimes things get set and are either kind of forgotten or left to their own devices, and your allocation can get severely skewed in good years and in bad years, because we have to be monitoring and getting back to our comfort level, because they can quickly kind of go out of our safe zone if we're not monitoring what we're in. And on that note, if you are invested in a target date fund, often in 401ks and 403bs, they're tied to an assumed retirement year, so usually by increments of 5 years. They're great places because they do adjust the allocation as you get closer to retirement, but you want to check in every couple of years and make sure that allocation still aligns with your goals and long-term plan there, because they can adjust more than you would want, and it's hard to kind of monitor that under the hood. And then the other piece kind of goes into taxes as well, but do you have taxable or brokerage accounts that you're invested in? One thing we do a lot for our clients is tax loss harvesting. So if there are losses on the holdings, we will move to a similar investment in the same space and capture that loss for the tax return while staying invested in that asset class. So make sure we're taking advantage of the opportunities when they arise and setting ourselves up for a good tax situation this year and also in future years there.
Alexa, I would mention we just had a conversation with someone yesterday, and new to us, they have their accounts at a different firm, and we mentioned double check your cost basis method if you have a taxable investment account, because nowadays some of that decisions on how much tax cost there is when you trade in an account occur within the cost basis method. There's different choices, average cost, minimum tax, etc. Feel free, if anybody has follow-up questions about that, we can talk about it in the Q&A section, but there's little things. And I love the target date example. Also, I think in a year like this year, the biggest companies and the growthiest companies, like NASDAQ companies, have done the best. So you may have started out and they were a smaller portion of your overall allocation, and they ballooned because other things have been kind of flat to negative. Of course, it feels good to have more of the stuff doing really well until everything reverts to the mean. So those are some areas that you may want to focus on when you're trying to rebalance things. And of course, we help people with this along the way when they're working with us.
Yes. And then taxes are a huge part that kind of plays into every aspect of the financial decisions. And if we go to the next slide, it has a couple of the options and opportunities that we are looking out for throughout the year, and especially at the end of the year. So current clients, you probably got emails from us asking for the tax return, and either in May or if you did an extension pretty recently. So we really are always looking for opportunities to save on taxes, and a couple that really come up is using tax efficient retirement vehicles. So we're looking at if your taxable accounts have, are we using mutual funds? This time of year, they are paying out capital gain distributions, which will hit your tax returns. So if we have the option and we want those funds, we're trying to put those in IRAs and Roth IRAs to not have the tax bill hit you there. Capital gains and losses, if we are having to sell stuff, we're looking at what makes the most sense tax-wise and capturing those losses when they are available. For people who are charitably inclined, there are a lot of opportunities to really maximize what we're able to give to the charities. There's a whole slide on that, so I won't go go too deep in there. And then Roth IRA conversions. If you are retired or in a low income tax year, it may make sense to convert some of your traditional assets to the Roth bucket. And then also for, younger or people in that accumulating phase, it may make sense to do a Roth 401k or Roth IRA contributions there. So those are a couple things we look at, and we also kind of are forecasting what happened in 2022. What are we expecting to happen in 2023? Has income changed? Has your filing status changed? Do you have stock options we need to be aware of impacting the taxes? What are we, forecasting, and how can we make that something that we are being proactive about rather than just reacting when it happens? So there's a couple ways we can handle that. And I know we've had a couple conversations towards the end of this year of, hey, if we're able to, increase the 401k contributions, that can help lower the income for this year. And kind of, we have, I think, 7 weeks until the end of the year. So there are still some moves that we can make if we need to. And on the other side, if we're looking to maybe fill up a lower tax bracket, we're working with CPAs to say, hey, it's a lower year. Should we fill up this tax bracket and take advantage of the situation we're in right now?
I think that this area, the tax discussion, is where there's been the biggest acceleration in terms of capability in the financial planning world. And only some clients are getting that. So if you work in some investment advisory organizations, you're not even allowed to ask for the tax return. And so you just don't have those details. And with new software, the ability for us to have space for focus on taxes, when people say focus on what you can control for a better life, this is one of the areas that in many cases you can control taxes. And one of the things you can control is just information. You may not have a choice on the tax costs, for example, on restricted stock units, or if, hey, we want you to earn good money. And in that case, that might create taxes. But knowledge is power. So being able to know before you get a big unexpected tax bill in April, what is coming down the pipeline, hey, that's just like table stakes. But then if you can add to and say, over time, this might be a strategy that potentially could reduce your taxes. We are not your CPA, but we would love to talk to them about this idea or that idea, because a lot of times they're just reporting information that's already happened. Those are where I see a lot of growth in capability for firms like ours that do incorporate, knowledge about tax into both our investment strategy as well as our financial planning process. So that's just like one of the most exciting and impactful areas of a financial planning.
And then these are just the rates for 2023. So it's important to know what the thresholds are for this year, what the standard deduction, and the next slide has 401k and IRA maximum. So these are for 2023. Melissa will have the updated numbers for 2024 in further slides, but just to know what our limits are and what we are able to put into these vehicles, the 401k, 403b, as well as the catch-ups and all of that associated with those contributions.
There are so many numbers here, and that's part of the function of like, how do you keep track? There, many of them, if not most, are inflation adjusted. If you're getting a gift from your grandmother every year and it was 15,000, it turned into 17,000. That's that gift tax exclusion on the top right. I know we're just kind of glazing through these areas of information, but if you have specific questions, another area is the how much you can put in a health savings account, or when do you phase out on a Roth? our monthly newsletter is going to have all of this in it. This download of 2023 important numbers, just so you can refresh and make sure you did everything right this year. And then we'll have the update, the 2024 numbers on both our website as well as in our newsletter coming up really soon.
Yes. And then to the retirement savings. So there are a few options to save after 12/31 for 2023. But if you are saving in your 401k and 403b accounts, those have to be in by 12/31. So if we are looking at, ways to decrease the taxes for this year, it may be bumping up those contributions for the next couple paychecks that we have left this year. And then a big thing to consider and review is, are you using Roth versus traditional? Melissa talked about the phase outs, and a lot of 401ks offer a Roth option to save there. And when we are looking at Roth conversions, it's a similar conversation of, what do you think the taxes will be in the future, and kind of deciding if it makes sense to do the Roth or traditional. So we had a conversation yesterday where we're in a higher tax bracket doing Roth 401k contributions. And the goal is to retire early. So there are going to be years where we are in low income tax brackets. So we said, hey, this could save you, a couple thousand in taxes if we make the switch from Roth 401k to traditional, knowing that when you're 63, we have a couple years we can do conversions to get it into the Roth bucket, and saving it now. And every situation is different, and for them, there were years where they were getting that Roth bucket built up, and that was good for their situation. But at a certain point, when the income grows, the situation changes, and it's time to make that change. So it is very specific to, one, what your thoughts are on where tax rates are going, what your income is, what your plan for retirement is. But there are a lot of discussions we can have about what makes the most sense for you, what your goals are. And also another thing to consider is, what the plans are after your passing. If your children are going to be inheriting a huge traditional IRA, with the Secure Act 2.0 change, they now only have 10 years to take those assets out, which would be at ordinary income rates. So if your kids are in their highest earning years, having to take these large sums can kind of impact their taxes there. So it's a morbid piece, but it's something to to think about, is how do you maximize what you and your family get rather than the IRS?
And the bottom line is it's complicated. So, take some of this information, and then, the next step would be have a conversation. Don't just take, the internet's or Alexa's and my advice as what you should be doing. Talk about your personal circumstances. It's nuanced, but we can talk you through those, both with the dollars and cents as well as the, kind of head and heart part of the conversation.
Yes, it's very, very specific, and we love to have those conversations. And then one thing that is, not really a conversation is the required minimum distributions. The IRS says you have to take this, and if you do not, there are penalties, and they have over time changed when these have to start. Right now, if you're over age 73, and that is being slowly phased to age 75. So just making sure you know when you have to take those. If you work with us, and you're of that age, you've been contacted about taking the required minimum distribution. And that's based on the prior year, the 12/31 value, and then an age table, and they calculate that amount. So just making sure you're doing that. on that, if you give to charity, you're able to give directly from your IRAs to avoid that income tax bill on what you give. That is able to start when you are 70 and a half. So while the required minimum distribution age has gone up, you're still able to start giving to the charities at 70 and a half. So they have not moved that bar with that. So one thing to note, and then also if you are a beneficiary on an IRA or a Roth IRA, depending on the date of passing, there could be required minimum distributions each year if it was prior to 2020. And if it was after 2020, we have 10 years to take those funds out. And it can be lump sums, it can be over the same over 10 years, however you want, but it does have to go out. So that is another opportunity for some strategy in what year makes the most sense and what do we anticipate over the next few years. And then just a quick note on open enrollment. If you have benefits, it's a good time to really take a look at what you have. Does it still make sense for your situation? Comparing spouses, which one works best for you, the family at this time, and then also just looking at what the actual coverages are. Do they offer life insurance? Is the coverage that they offer adequate for your needs and your family's needs? Are there options to increase that, or does it make sense to look outside the company to get that coverage? Also, looking at disability insurance, do they have health insurance that allows for health savings account contributions? Those can be a huge thing for the family if it makes sense for the situation. Flex spending accounts. Just kind of taking the time. It's not, I know in my family, it's not a fun thing to do, but there are, a lot of opportunities to enhance your picture by selecting the right benefits for your situation, which does change from year to year, and what makes sense in 2022 may not be the right answer for 2023 and 2024. And often employers are changing what is available or adding options over time. So University of Michigan, 2024 will be the first year they offer an HSA eligible health insurance plan. So, the conversations, is that the right fit? So we're happy to talk about, what you have and what makes sense in the situation on that. And then education funding is a really fun one. So in Michigan, you are able as an individual to get a state tax deduction up to $5,000, and for married filing jointly up to $10,000 when you contribute to your 529. So that is a great way to help kids or grandkids pay for college and higher education expenses. And a really wonderful thing is that the opportunities and uses for 529s has been really expanded. Now, if you have a 529 that's been open for 15 years, and if it hasn't been depleted for college costs, it can be used for Roth IRA contributions up to $35,000. So that is a really great thing. I think we probably should have a 529 webinar next year just to go over all the
Consider it done. You will be hosting.
all the fun stuff. And then on the FAFSA, that usually is October, but they're making hopefully enhancements and improvements. So that will be available sometime in December. And then coming back to taxes, if you have kids in college, depending on your income, it may make sense to pay some of those costs directly from your cash rather than all from the 529 to take advantage of either the American Opportunities Credit or the lifetime learning credit. Like that one escapes me, but there are a couple ways, we can save on taxes, and it's just being flexible and kind of when the time is right, knowing what the options are and your situation. And I talked a little about charitable gifting. There's really a lot of options and fun things that we can do to give to charity. One thing is bundling or bunching your charitable gifts in 1 year. So we would say, okay, we're going to give our 2023 and 2024 gifts in 2023 and take advantage of itemizing deductions. And then next year would be the standard. As I mentioned, the qualified charitable distribution, once you're 70 and a half, to give directly to the charity from the IRA and reduce the tax liability on that. If you have appreciated stock, we can, give that to the charities. We can look at donor advised fund. There's a lot of really fun things that we can do to maximize what the charities are getting and kind of cut out the IRS. And I think over the years, they have really become a lot easier to administer and operate these avenues for giving to charity. So if that's something that is a goal to you, we can definitely help maximize what we're able to do. And then Giving Tuesday is the Tuesday after Thanksgiving. So a lot of charities have promotions, and it's just a great time to support those charities that you really care about. And this is my last one, so I'll be done soon. Estate planning, we just want to make sure you have your estate planning documents in place. If it's been 3 or 5 years since you did them, take them out, dust them off, make sure the people you've identified in there, that they still make sense. Who are your beneficiaries, making sure all of your accounts have the proper beneficiaries. So your retirement accounts, bank accounts, is your house properly titled? It's always good to have a fresh look at it and make sure everything is going where you want it. Life insurance policies, all of that. If you have kids that are, 18, it still seems very young, but they are technically adults. Do we need to get, power of attorney things in place for them? It's it's not a fun thing to think about, but if there ever was a situation, it can be very helpful to be able to help and support them if needed on that. So take a look at those. Also on the benefit discussion, some work plans allow or offer estate planning services. So if you are eligible or if you are paying for the estate planning services, definitely take advantage of those and get something on paper there.
Oh, back to me, and we still have more to go. I was thinking, Alexa and I we care so much that people are able to get things done that are important and may not feel straightforward, may not feel easy. You just covered estate planning. I think about life insurance in that same place. And there is just so much to tackle in general, that hopefully some of these details are sinking in, whether they're relevant today or will be over time. Just, kind of information to pick up along the way. One reminder is that Social Security is inflation adjusted. And so there was a big bump last year. It's going to be smaller this year, but 3.2% increase in Social Security for those of you who are receiving it. And it's also an important factor in how we calculate your Social Security for the future, which we do still think will exist. Maybe there will be some tweaks along the way. But it's important, if you're a retiree listening to this, that you let us know what your new gross Social Security is, so we can refresh our software and make sure it gives you all the credit for what you're earning. There will also, for the average retiree, that's $140 more per month. And then Medicare Part B is going up by almost $10 to 174.7 per month. Oftentimes, tax brackets matter when you get to be Medicare age, which is over 65, because there are extra payments that you make. It's essentially a tax called IRMA when you're in a higher tax bracket. Another good reason to kind of manage for taxes. But it's nice to see that Social Security is going up. Other things that are linked to inflation, also in some cases increasing. IRA contributions, that same goes for Roths, are going from 6,500 to 7,000 for most of us. But if you're working and over age 50, you get an extra $1,000 catch up that you can also add in. Health savings accounts are increasing. We know that healthcare costs like to increase along the way as well. If you are participating in a high deductible health plan, then as an individual, you can put in $4,150. And as a family, you can put in $8,300. There's a catch up at age 55. And that catch up is for both individuals. So if spouses both turn 55, there's an extra 2-time catch up. And then 401ks are increasing just by $500 from 22,500 to 23,000. That'll be 30,500 if you are over age 50. So the catch up doesn't change, but the amount total does. These are all great ways to both control your taxes either now or later and also get prepped for retirement. You know, kind of the number one thing that people really care about when they come to us is, will I be okay when I'm not working anymore? And so paying attention to these catch-up contributions, don't leave your deferrals to autopilot unless you've got it automatically set to increase each year. And remembering that your match, which is often 3%, could be more or less. Your match is not your max. So keep that in mind, and, you know, might as well just log in to your 401k if you have one, and look and see how much you put in this year. You could even put in a little more before the end of the year, or email your advisor and say, did I do that backdoor Roth or traditional contribution? And there's even more kind of planning ideas if you're a business owner. So if you are a business owner and you're listening in, reach out to us and we can discuss the specifics for your types of retirement plans. So I thought I would just sum up some of the themes that both, you know, like proactively we've brought up, but also we've been talking about a lot with clients this year. I mean, the one that we've talked about a time and again, a few years ago, it was like iShares that were paying high yield for a moment, and they're still a reasonable investment. But this year is managing your cash for yield, because we went through many years, really most of the time since 2008 and 2009, with just almost nothing paying you in the banks or otherwise. And really, I mean, who's going to get that excited about a 1%? But for many of us, if you pull up your bank account, you're like, oh, I get 0.02 on my savings account, or 0.1 in terms of my yield. But nowadays, because interest rates have radically changed from a few years ago, or even a year ago, you can actually get paid on the cash that you're saving. And what a reward for savers that they actually can try to keep up with inflation. Or if inflation were 3.2% this year, when the yields are between 4 and as high as 5.5% in money market world or CD world, or treasury bills, getting paid on your yield does not require you to take a lot of risk. So this is something that has definitely been thematically, like, we're talking about all the time, and you just never know what it's going to be from year to year. But that's something we like to broadcast wide and far, that you can, get paid for being a saver. We also have a new bond frontier. I'm going to talk about that in just a moment. Alexa and I have spent a lot of the year, and the whole team here has gone through, and we're not done yet. This will bleed into 2024, but just evaluating people who may make sense to have long-term care insurance. It's a conversation, we kind of don't get excited to. We're not insurance salespeople as by trade or purpose, but reviewing long-term care is something that's great to do in midlife. And a lot of people are coming to us and asking about us when they're getting toward retirement age, 60s or 70s, but it tends to be more affordable if you plan for it earlier. And then, like I said, tax planning, just we're able to go to a different level because we're able to get better information. We also have more tools, I believe, in terms of both how we understand and manage and inform you on taxes over time. So those are some kind of, when I kind of gather things up, 2023 areas of focus or themes. When I talk to people, I need to remind them, we even in our year end or our fourth quarter investing and economic webinar, we did a bond boot camp basically, where we revisited some of the truisms of bonds. And this is just a reminder, because a lot of people are like, why do I own these horrible investments called bonds? They're supposed to reduce the risk in my portfolio, and all I've gotten is uninspiring returns over the last 10 years and certainly over the last year and a half. That equation has radically changed because now you have an interest rate. And so on your average US aggregate bond, the average yield in the index is about 5.4% as of September this year. And when interest rates go up from this range, it's much less harsh and harmful than it was when interest rates were going up from 1%. The returns there, you get paid a yield. And so things just work out much better. And you can see that in the orange. If yields rise 1%, if the Fed increases rates more because there's more inflation, the price goes down by 6%, but the yield goes, you still get paid your yield. And so you add that 5% back, and instead of getting, -5, -10% returns like we've seen recently, you get basically a flat return, -0.8. Rates go unchanged. You get paid your interest rate. There's no headwinds, no tailwinds, and you get your 5%. But then when rates fall, which would happen if you've been predicting a recession, you're just waiting for the announcement, then there may be a pause and then eventually a reduction in interest rates. That's what typically happens with the Federal Reserve. Well, that equation, you get your yield of 5%, but you also get a price return of 6%. I mean, of course, all of these are projections, but this is kind of the bond math, the way things work. And I like to remind people of that, remind people that it's a much better kind of bond environment than it was a few years ago. We're taking this information in as we structure portfolios, and we also are just reminding you that bonds are going to serve their purpose going forward, and yields certainly help in terms of the math of bonds. Another equation I've used in money markets, the price goes up and down, like the yield, I should say, goes up and down like an elevator. The price stays the same. But you can get out on the first floor or the third floor. If interest rates go up, maybe you're on the fifth floor, 5% yield. When interest rates go back down to 3%, so does your yield on your money market, and the price stays the same. In bond world, it's a seesaw. If interest rates go up, the price goes down. And if interest rates go down, the price goes up. So, you don't get the same kind of protection in a recession traditionally with a cash or money market in terms of its yield versus the bonds, which would change the price to go higher. Okay, thanks for listening to my lecture on bonds. Back to some things that we think we may be focusing on going forward. Withdrawal planning is something that Alexa, is related to what Alexa was talking about with taxes, but we're really working on boosting the level of sophistication with when you are retired, taking money out of accounts and knowing what the taxes related would be and trying to mitigate or manage taxes over time. So that's certainly an evergreen conversation, but one that we're having more and more. We also are reminding people that estate planning is important. Refresh if you have people listed in your estate plan that need to be changed, or your circumstances have changed. Maybe the kids were minors when you drafted your estate plan and now they're adults and they could be your successor trustee. Just make sure you're reviewing things. We do have additional tools and options. Always love working with attorneys and coordinating with them on your behalf. But for those of you that have been reluctant to hire that attorney, we're trying to make sure that you have adequate things in place as well. I'll skip over and say property and casualty insurance reviews. There's more and more storms out there. Some of our clients are in climate impacted regions. We just want to make sure, and property values have skyrocketed. We want to make sure you're adequately insured. So if anything did happen to you, that you would have proper and adequate coverage at a reasonable cost. And so we have some new tools to do property and casualty insurance reviews that we'll be rolling out in 2024. Not my favorite topic, but it's going to be an election year next year, which everybody wants to know, if this person wins or these people, then what's going to happen. I am of the camp that, politicians do not run our economy. They may influence it. They make certain decisions. Certainly tax law may need to change because the Tax Cuts and Jobs Act sunsets in 2024, but it would be easy to spend the entire year in a tizzy with a lot of stress over a lot of things that you cannot control. And we're really going to try to focus on the topics that we can control. Sound investing process, really facing elections and realizing they matter in your personal life, but they may not decide how your portfolio behaves. So a couple tools to remind people of that. I always use this quote recently in conversations because it is so easy with the world's news to feel pessimistic about just about everything. And so I like to remind people that it's very easy to catastrophize. As Michael Antonelli says, we're in a world that will always jump to the worst case scenario whenever something happens. And that is amplified by a world where when you are scrolling and you see something that's negative, it makes you click. You want to make sure the sky is not falling, but then you can go down into, whether it's on TV, on the internet, on TikTok, then you can end up going down a rabbit hole that is very negative and just fuels you with pessimism, increases your cortisol, and does a lot of negative things. So don't forget when the sun is out that you don't have to focus on the rain on the TV, like the guy holding his umbrella up on a gorgeous day. It never feels like the perfect time to invest if you're looking for the perfect moment. That's where process can really help you. And just if you need this chart on the right, developed my good friend Ashby Daniel. You want to see it in real life, then we just forward the screen to all of the world events. I haven't had a chance to add events of 2023 to this chart, but there's just so much going in the world that can feel like worst case scenario. And yet, over the same time period, going back to the late 80s, you have a stock market that's had 4 recessions. Those are the gray areas, and 9.9% annualized return. And you just can't predict which moments are going to be the most difficult. And you can also, when you see a negative headline, it does not always correlate into the market. The market doesn't care who wins the election, although I know it matters in your personal life. So just kind of trying to set the table. We're planning to have some additional conversations on that, as well as we'll be happy to talk to you about specifics that you have concerns with. But I want us to kind of forecast and be prepared to not be triggered by living through another election year, which they seem to come more and more often as we age. And just as I wrap things up, hopefully we've touched on a variety of things, and there's a few things that you can either say, yep, I'm doing a good job, or here's a couple things I'd like to get done either now or next year. This reminder that people tend to feel more confident when they have a formal financial plan. Some people do that themselves, and there's nothing negative about that. But determining and documenting your financial goals helps you to feel more confident that you have control over your life and your finances. It also helps you feel more confident that you have the ability to manage through an unexpected negative outcome. And, I've taken 2 studies, both by Charles Schwab and Fidelity, that look at how people report they feel about their money that people who are similar otherwise, when they have access to financial advice, and when they have a formal financial plan. So just know if you're someone who's kind of on the fence or thinking about putting that on your list of action items. I had a friend last weekend who's like, I don't want to hear the word self-care anymore. It's, or mindset, but it really helps to frame your mindset and increase your well-being when you can reduce your anxiety and increase your confidence in these areas like saving for retirement, minimizing taxes, is your estate in order? Saving for goals you love, like vacation. This is just a process that tends to be helpful for people. That's how they report versus sample groups that are not working with that financial plan and receiving financial advice. So I would encourage you to spend more time on your plan and also the perspective of market history, which we're always happy to give you every quarter and in our personal one-on-one conversations. But you can always look back on our YouTube webinars on investment and economic outlook that happen quarterly, and spend less time on, the doom and gloom that comes with headlines or daily, kind of the volatility of daily market movements. We have time for Q&A, and thank you so much to the attendees who have joined us. But if anybody has any burning questions, you can find in the little Zoom toolbar, there's a Q&A section, and feel free to punch one in if you have any questions. You can always follow up with us on or you can follow us and learn about events like this on our social media. But also our newsletter always includes our events over time. When Alexa does that 529 webinar she's promised all of us on the presentation today, the invitation will be available in our newsletters. We also have weekly podcasts that are often on financial topics. Oh, and good, we have a question. I will also share our contact details. You feel free to call our office. Okay. What is the minimum charitable amount required to itemize? That is a good question. Let me go back and see if our chart has a list of the standard deduction, which is going to change next year. It's also linked to inflation. And if not, I'm going to do a quick Google search because I don't know this one by heart. But I do know where to find the answer. Okay, standard deduction, it's right here. Married filing jointly is $27,700, and if you're single, it's $13,850 for 2023. It will be adjusted and it will be higher next year. That's why when you think about what needs to be added to this, traditionally it's your charitable gifts, it is state and local taxes. So for unfortunately, right now, state and local taxes are capped out at $10,000. It used to be that many of us itemized because those taxes would take you into the range, and the standard deduction also used to be lower. And so then the other component is your medical expenses. And so all those three kind of tally up to give you additional information. You can see over age 65, how that gets impacted. What we like to do in our software is we look at a previous year's tax return, the most recent year if possible. Then we can actually go and compare a standard deduction. I was just doing a calculation like this today versus an itemized. In the case that we did this calculation, it's the last year the family's working, and they tend to bundle and do bigger charitable gifts every few years. And so since they are planning to go down in terms of tax brackets, we're talking about how much they might do before the end of the year due to that bundle. Oh, I should mention, I forgot. Sorry, I'm just talking and I forgot one important component. Mortgage interest also included up to $750,000. If you're somebody who's fortunate and you have your mortgage paid off, win. Or if you had, a 2.9% mortgage rate because you got a refinance in those very low rate years, hey, that interest may not be that high, and that's a win in other parts of your financial life, right? But now interest rates are higher. If you bought a house more recently, it's your primary residence, you didn't take a HELOC out, a home equity line of credit in order to, start a business or something. This is your mortgage interest. The $750,000 of that loan, the interest associated with it would be part of your standard deduction. That's coming back into play. It'll filter in waves. So not everybody, doesn't apply to everyone, but it does apply to some people. And that is a part of that itemizing. We will also, and you will be hearing this more in the election year too, the Tax Cuts and Jobs Act sunsets in 2025. And so we will have a revisit where potentially state and local tax could come back into play at a higher level for those of us that live in higher tax states. Also, that could change the standard deduction as well. So everything's subject to change, and we try to keep abreast of all of those things. We don't commit everything to memory, but we know where to look them up, and we know how to explain how things work. When we don't, we find the answers for you. Okay, we've got another question. I have a trust scheduled for younger children. But should I also make them a beneficiary on my accounts, or let the trust take over? It's a really important question. There's a lot of nuance to the answers. If the beneficiary on your retirement account is your children and they're minor children, then there are provisions, and sometimes in some states, trust can also be created kind of as an outcome. But there are provisions that the kids wouldn't have to take the funds out the way a normal beneficiary would with the new beneficiary designation rules. There are a number of years that are options. A lot of people like the trust to be responsible, because then from your, drafting, hopefully in a normal, good time of the trust, then you can kind of lay out who's in charge and for how long, and they can be a trustee, so that you have the opportunity to not, kind of say, hey, kiddos, you're 19 years old, may not have a fully like developed frontal cortex, and decision making with large sums of money may be a little more impulsive than we are in our 40s or 50s, although, who's ever ready for big sudden amounts of money? It is emotional roller coaster. But you may want to have more control and say that the funds would be available for health, education, and maintenance and support. But I don't think like, a 19-year-old should get $250,000 just, to spend at will. Because there sometimes is value, or often, in my opinion, for having a trustee for a little bit longer than the age of majority. This is a great discussion to have with the person that drafted your trust. The funding instructions would be tailored to you. Some attorneys have different opinions about funding trusts. We tend to, because we have to operate in an environment where sometimes successor trustees need to come into play, whether it's competency or just there's a situation where for a period of time someone can't make decisions for themselves or would like, to delegate. And the trust has a lot of powers that are more difficult to kind of enforce by going to a court and seeing how the judge feels about your kids or family circumstances. Unfortunately, probate and dealing with financial matters after someone passes away is complicated on the best, most well laid out day. So it's great to ask these questions and follow up. You can follow up with us and the attorney that drafted the trust. And also, if you don't have someone to ask, we can always make connections. We love to make referrals to good people out there. So I hope that's helpful information. These are great questions. Once you get the estate plan done, like what do you do next? Well, you got to like fund that estate plan. And did you, update the deed on the house, or did you forget to mention that you own an inherited property with your brother that's in another state and it just wasn't top of mind because it's complicated? All of these things are things in the back of our mind. We're kind of thinking through. Sometimes I even say the things we like kind of check off out loud just to know, like, hey, we're bringing you the things that we think you need to focus on. We're trying not to overcomplicate your life or just create overwhelm. But here's some other things that we, kind of checked off and said, no, not a need on that. Anything I'm missing, Alexa, or should have mentioned?
No, I think that was good. And yeah, I think talking with the attorney who drafted it, oftentimes they have a funding instructions list of, you need to change this. We need to update the beneficiary here, do a deed to the house. So it does kind of give you the marching orders of, okay, now I have this trust, but what do I do with it? Not just put it in a box and and leave it there. So they'll usually tell you exactly what needs to change and how it would work.
Yeah, and I can tell you, if you're feeling fatigue after you've gotten done with an estate plan, because it does take some emotional like it takes some of your emotional endurance to get through some really tough questions that you don't necessarily want to talk about, about if something bad happened to me, what would happen? I mean, minor children are a prime example. Who's a perfect guardian for your kids? Like no one in most cases. But you still have to come up with someone who's better than, none. Um, and so when you get done with that process, you're like, oh my gosh, finally, I accomplished it. Like, we pulled everything together. We did that signing. Now I've got this pile of papers. And if you don't like kind of pull it together to do that last phase of like, oh, but my mom is still the beneficiary on, this old 401k because I haven't logged into that account in forever. That can really, that just can um, set you back. And wasn't the point of the money you spent on the estate plan to begin with. So prime example where it's helpful to like, either an accountability partner with your spouse, make a commitment with yourself or with the, successors, say, I am committed to getting these things done. If you work with a financial planner like us, we're really trying to make sure that we're identifying the areas where you need extra steps, and a great estate planner will give you that list as well, of, hey, did you do this? A really great estate planner would follow up as well. But everybody's in a different level of engagement, and that might add cost as well. But always food for thought, and it's not too late to put that on your list of incremental items. Well, with that, I am so appreciative of this audience who really stuck through all the way to the end. The recording will be available on YouTube, and we'll look forward to more to come in 2024. Thanks for listening, and feel free to reach out if you have any questions. Great job, Alexa.
Thanks. Have a good day, everyone.